Today, we're diving deep into a fascinating corner of the ETF world, the equal weight SP 500, also known as RSP. Forget everything you think you know about traditional SP 500 funds, because RSP flips the script. Instead of letting giant companies dominate the portfolio, RSP gives every stock in the SP 500 an equal slice of the pie. But is it a recipe for market-beating returns, or just a strange financial experiment? We're about to find out. So buckle up, ETF enthusiasts, because the next 30 seconds are going to be packed with RSP insights. Question 1. What is RSP ETF? The Invesco SP 500 Equal Weight ETF, ticker symbol, RSP, is an exchange-traded fund, ETF, designed to track the performance of the SP 500 Equal Weight Index. Here's a breakdown of what that means. Exchange-traded fund, ETF. An ETF is a basket of securities that trades on a stock exchange, like a single stock. RSP provides exposure to the SP 500, but with a unique twist. SP 500 Index. This is a market capitalization-weighted index that tracks the performance of 500 large-cap companies listed on U.S. stock exchanges. However, RSP takes a different approach to weighting these companies. Equal Weight Index. Unlike the traditional SP 500, where the largest companies have the biggest influence on the index's performance, the RSP ETF allocates an equal weight to each of the 500 companies in the index. Here's a deeper dive into how RSP works and what to consider before investing. Investment strategy. Focus. The primary objective of RSP is to provide broad exposure to the U.S. large-cap market with a twist. Equal weighting aims to capture the performance of all 500 companies, not just the biggest ones. Replication. The ETF typically uses a physical replication strategy. This means it actually buys shares of all 500 companies in the SP 500 Equal Weight Index, in proportion to their weighting. Rebalancing. To maintain the equal weight methodology, the ETF periodically rebalances its holdings. This involves buying or selling shares of companies in the index to ensure their weights stay aligned with the target. Potential benefits. Reduced concentration risk. By equally weighting all companies, RSP avoids relying on the performance of a few large companies that dominate the traditional SP 500. This can potentially lead to a smoother performance compared to the market cap-weighted version. Exposure to smaller companies. Equal weighting gives some exposure to smaller companies within the SP 500 that might outperform larger companies over time. This exposure to the size factor can be a potential benefit. Diversification. Holding all 500 companies offers broad diversification across various sectors of the U.S. economy. Question 2. What is the primary objective of the RSP ETF? Is it capital appreciation, income generation, or a combination of both? The primary objective of the Invesco SP 500 Equal Weight ETF, RSP, is capital appreciation, though it may generate some income along the way. Here's a breakdown of why. Focus on growth. The core purpose of RSP is to track the SP 500 Equal Weight Index, which aims to capture the overall growth potential of the large-cap U.S. stock market. By including 500 companies and weighting them equally, the ETF spreads its bets across various sectors and growth opportunities. Limited income focus. While some companies within the SP 500 pay dividends, the equal weighting methodology doesn't prioritize high dividend payers. The income generated from dividends within the ETF would be a byproduct of owning the underlying companies, not the primary driver of returns. Long-term growth strategy. The ETF is designed for investors seeking long-term capital appreciation through exposure to the U.S. equity market. The equal weighting approach aims to capture the growth potential of all constituents within the SP 500, not just the current market leaders. Here's a further explanation of why capital appreciation takes precedence over income generation for RSP. Equal weighting and dividends. Since dividends are not considered when weighting companies in the index, a high dividend-paying company wouldn't have a larger influence on the ETF's performance compared to a low dividend payer. This reduces the emphasis on income generation within the ETF's objective. Focus on all 500 companies. The ETF offers exposure to the entire SP 500 universe, including companies that might prioritize reinvesting profits for future growth rather than distributing dividends. While RSP might generate some dividend income, the amount wouldn't be the primary focus of the ETF strategy. Investors seeking a high and consistent stream of income might be better suited for dividend-focused ETFs or other income-generating asset classes like bonds. Question 3. How does the ETF track the underlying RSP index? Does it use full replication, sampling, or optimization? The Invesco SP 500 Equal Weight ETF, RSP, typically uses a physical replication strategy to track the underlying SP 500 Equal Weight Index. Here's a breakdown of what that means and how it differs from other tracking methods. Physical replication. Direct ownership. In a physically replicated ETF like RSP, the fund manager aims to hold all the securities that make up the underlying index, in proportion to their weighting. For RSP, this means buying shares of all 500 companies in the SP 500 Equal Weight Index with a weight of roughly 0.2% each, assuming 500 holdings. Benefits. This approach offers a high degree of transparency as the ETF's holdings directly mirror the index composition. It also ensures the ETF's performance closely tracks the index, minus the impact of fees. Alternatives to physical replication. Sampling. Some ETFs might use sampling to track an index. This involves holding a representative selection of the index constituents, not all of them. While potentially more efficient, sampling introduces some tracking error as the ETF's performance might deviate slightly from the index. Optimization. Optimization is another alternative where the ETF uses mathematical models to select a subset of securities that best captures the risk-return profile of the target index. This can be more cost-effective but also introduces tracking error. Why physical replication for RSP? The SP 500 Equal Weight Index has a specific characteristic that makes physical replication a practical approach. Large number of holdings, with 500 companies in the index, each with a relatively small weighting, around 0.2%, the impact of buying and selling costs associated with frequent trading might be less significant compared to a smaller index. Liquidity of large-cap stocks. The underlying companies in the SP 500 are generally large-cap and highly liquid stocks. This means they are typically easy to buy and sell in large quantities, minimizing the challenges of physical replication. Question 4. How often is the ETF rebalanced to reflect changes in the RSP index? The Invesco SP 500 Equal Weight ETF, RSP, typically rebalances its holdings to reflect changes in the SP 50 stock index on a quarterly basis. Here's a deeper look at the importance of rebalancing and how it functions within RSP. Importance of rebalancing. Maintaining equal weights. The core function of the SP 500 Equal Weight Index is to ensure all 500 companies have an equal weight, around 0.2%, within the index. This weighting methodology aims to reduce the influence of large-cap companies and offer broader exposure across the U.S. large-cap market. Market price fluctuations. Over time, the natural fluctuations in stock prices can cause the weights of individual companies within the index to deviate from the target 0.2%. For example, a company that outperforms the market will see its stock price rise, increasing its weight within the index if left unchecked. Rebalancing as a correction. The quarterly rebalancing process addresses these weight discrepancies. The ETF manager buys or sells shares of specific companies within the fund to bring their weights back in line with the target 0.2% allocation. Rebalancing mechanism. Active management. The rebalancing process is actively managed by the ETF provider, Invesco in this case. They analyze the weight deviations within the ETF's holdings compared to the target weights in the SP 500 equal weight index. Buying and selling. Based on the analysis, the ETF manager will buy shares of companies that have fallen below their target weight and sell shares of companies that have exceeded their target weight. This ensures the ETF's composition continues to reflect the equal weighting philosophy of the underlying index. Impact of rebalancing. Transaction costs. Rebalancing involves buying and selling securities, which can incur transaction costs. These costs are reflected in the ETF's expense ratio. Tax implications. Depending on the specific rebalancing activity, there might be some tax implications for the ETF, potentially impacting its net asset value, NAV. However, these are usually minimized through strategic rebalancing techniques. Performance impact. In theory, frequent rebalancing in an equal-weighted ETF, like RSP, can lead to higher turnover compared to a market cap-weighted ETF. This higher turnover might result in slightly higher expense ratios and potentially some tax implications. However, the potential benefits of maintaining the equal weighting strategy and potentially capturing the size factor, better performance of smaller companies, can outweigh these drawbacks. Question 5. What is the total expense ratio of the ETF? How does it compare to other RSP ETFs and actively managed RSP funds? The expense ratio of the Invesco SP 500 equal weight ETF, RSP, is 0.2% as of September 30, 2023 according to Invesco's website and other financial data sources. Here's a deeper look at how this expense ratio compares to other investment options. Comparison with other RSP ETFs. Competitiveness. 0.2% is a generally competitive expense ratio for RSP ETFs. There might be other RSP ETFs with slightly lower expense ratios, but the difference might be minimal. Factors like the specific index provider and replication strategy can influence expense ratios. Focus on lower costs. For investors seeking the most cost-effective way to access the RSP strategy, comparing expense ratios of various RSP ETFs is crucial. A lower expense ratio translates to a higher portion of your returns being retained within the ETF. Comparison with actively managed RSP funds. Generally higher costs. Actively managed RSP funds typically have higher expense ratios compared to RSP ETFs. These funds employ portfolio managers who research and select RSP stocks, leading to additional costs beyond basic management and administration. Expense ratios for actively managed RSP funds can range from 0.50% to 1% or even higher. Potential performance benefit. Actively managed funds aim to outperform the benchmark index, SP 500 equal weight index in this case, through their investment selection process. However, there's no guarantee of success, and historically, many actively managed funds underperform their benchmarks after fees are considered. Question 6. How sensitive is the ETF's price to overall stock market movements? The Invesco SP 500 equal weight ETF, RSP, is likely to be somewhat sensitive to overall stock market movements, but potentially less so than a traditional market capitalization weighted SP 500 ETF. Here's a breakdown of the factors influencing RSP's sensitivity. Market exposure. Broad market participation. RSP invests in all 500 companies of the SP 500 index. This provides broad exposure to the U.S. large-cap market, meaning its price will generally move in the same direction as the overall stock market. Reduced concentration risk. Unlike a traditional SP 500 ETF, where the largest companies hold the most weight, RSP's equal weighting reduces reliance on the performance of a few dominant companies. This can potentially lead to a smoother performance compared to the market cap-weighted version, especially during periods of high market volatility. Sensitivity factors. Correlation with SP 500. Despite the equal weighting, RSP's price will still exhibit a strong positive correlation with the SP 500 index. When the overall market goes up, RSP is likely to go up as well, and vice versa. However, the magnitude of the movement in RSP might be slightly less pronounced due to the reduced concentration risk. Sector diversification. RSP offers diversification across various sectors within the SP 500. While a strong move up or down in a particular sector can still impact RSP, the equal weighting across sectors might dampen the effect compared to an ETF concentrated in a specific sector. Question 7. Is the ETF heavily concentrated in certain sectors of the RSP market? How does this concentration affect the risk profile? The Invesco SP 500 Equal Weight ETF, RSP, is designed to have minimal concentration in any specific sector of the SP 500 market. Here's a breakdown of how the equal weighting approach reduces sector concentration and how it impacts the risk profile. Reduced sector concentration. Equal weighting philosophy. The core principle of RSP is to allocate an equal weight, around 0.2%, to each of the 500 companies in the SP 500 index. This approach inherently reduces the influence of any single sector, unlike a market cap-weighted ETF, where the largest companies, often concentrated in specific sectors, hold the most weight. Broad diversification. By including all sectors of the SP 500 and weighting them equally, RSP offers broad diversification across the U.S. large-cap market. This can potentially help mitigate the risk associated with an overexposure to any particular sector. Impact on risk profile. Lower sector-specific risk. Reduced concentration in any single sector can potentially lower the risk of the ETF's price being significantly impacted by a downturn in a specific industry. For example, if the technology sector experiences a correction, its impact on RSP's price would be less severe compared to an ETF heavily weighted in technology stocks. Potential for diversification benefits. The broad diversification across sectors can help mitigate some idiosyncratic risks associated with individual companies. If a particular company within the ETF faces challenges, its impact on the overall ETF price would be lessened due to the equal weighting and presence of companies from various sectors. However, it's important to note that RSP isn't completely immune to sector risk. Overall market sensitivity. Even with reduced concentration, RSP remains exposed to the overall health of the U.S. large-cap market. If all sectors experience a downturn, RSP's price will likely decline as well. Interconnectedness of sectors. The performance of some sectors can be interconnected. A downturn in one sector can have ripple effects on others, potentially impacting RSP to some extent.